Let's get you what we have been planning for and preparing for a very long time. In this global turmoil of both economy and financial markets, there are some companies that stand out on their own fundamentals. Our research team, like I just told you, has passed literally thousands of listed stocks through several filters like quality, growth, leverage, free cash, and they have come out with an A list. Today we get you the first few aces. The team is here with me. Let me start with you, Mangalam. You're watching Concor as your A pick.
That's right, Lata. So, Container Corporation of India on my A list for three big reasons. One, the fact that it's an industry leader. Second, it's got a very strong balance sheet. And third, that it has good visibility going forward in terms of growth drivers. So the key positives for the company, the first one is the fact that at 75 to 80% of market share in inland containerized traffic, it is an industry leader. In how? Because it also has the highest throughput capacity, around 22 lakh TEUs or 20 equivalent units across 63 locations. That makes it better than any other of its competitors. And now, not just this, going forward, the company is also investing about 1,200 crores towards building multimodal logistics park across the dedicated freight corridor, which I don't think a lot of companies have done. In fact, this is the only company which is working with in such close tandem with the Indian Railways, obviously because it's also promoted by the Indian Railways. The key growth drivers going forward will be a pickup in the EXIM or the export-import container volumes, which have been around 8 to 10% over the last 3 years, but going forward, the company expects it to be at around 12 to 14%. The second big driver will be the construction of the dedicated freight corridor, which the government expects to be opening by about 2019, and the company will be the biggest beneficiary of that. And also the GST, passage of the GST bill, whenever that happens, is always a big positive for all logistics companies. Now, if you look at the previous history of the company, the top line of that company is actually improving at an increasing pace and will improve more given the added capacity and additional revenues which will be generated from these added capacities. So if you look at the 5-year CAGR, the top line has grown at around 11%, but if you look at the 3-year CAGR of the top line, it's grown at around 15%, and last year itself it grew at 23%. The profit growth, though it has been subdued, it has also been subdued because of a few one-off reasons which the company expects will come off going forward. So the profit growth will increase. Now, coming to the third big positive of the company, the strongest balance sheet in the logistics business, because it's got zero debt, it's a high cash generating company. The consolidated cash flow from operations has grown close to 15% in the last 5 years, or in the last 3 years as well. It's grown to 1,200 crores. That's their consolidated cash flow from operations. And if you look at the valuations versus the peers, the stock has actually corrected about 22 to 25% from its July 2015 high of 1880. So currently it trades at its historic valuations of around 22 times FY17, which is down from 28 times FY17. And if you look at it, it factors in, these valuations factor in a PAT growth of 15% over the next 2 years, which is not a very optimistic estimate, fairly realistic. But the company actually commands a premium versus its peers like Gateway Distriparks and All Cargo, also because of its sheer size and the fact that it's located in 63 locations, and the fact that it has a great balance sheet, and also the fact that it has good cash. So the only downside risk would be a low volume growth in EXIM containers, but for all the positives, this company is on my A list.
All right, fair point. That's well argued. Sonia, you have something on your A list. It starts with an A.
Oh yes, it's Amara Raja Batteries. This is a well-discovered stock, as we all know. It's sitting at record highs, but the reasons why it's on my A list is because it has one of the cleanest balance sheets in the auto industry, and it has a very steady growth. And at times like this, when the export-oriented stories are flagging off, it's the domestic growth stories that people would want to look at. So look at the fundamentals. The stock is at a record high. It has clocked in a 21% revenue CAGR in the past 3 years. So one of the best in class in the industry. It's clocked in a 25% profit compounded annual growth rate over the past 3 years. And in the quarter gone by, the reason why it's at a record high is because the EBITDA margins touched 18%, not only the best in the industry, but the highest since Q4 of FY10. So it has beaten its own performance quite a bit. It's a debt-free company. It has been cash flow positive for the last many years. In fact, as on FY15, it has free cash of around 7 odd crores or so. Now, the stock is expensive. I must mention that. It trades at 30 times FY17 EPS, which is expensive compared to a peer Exide, which is trading at 17 times. So it's almost double Exide's valuations. But the reason for that is because it's been growing at a much faster pace than Exide. So in the full year of FY15, just to give you one internal, Amara Raja's margins expanded by 50 basis points to 17.5%, while Exide's margins declined by 50 basis points. So it's moving in exactly the opposite direction. Now, one big reason why people are bullish on Amara is because it has made all the investments for its capex expansion plans. So all of the expansions on capacities across two-wheelers, four-wheelers and the UPS, which is the telecom segment, has been completed, and now it's only time for those capex to bear fruit. So that's why going ahead, there is more upside potential. Now, I also want to mention that in the telecom market, it has been doing very well. Remember, it's the second largest player in the auto battery manufacturing business. But in the telecom battery manufacturing business, it is the largest player. And in the quarter gone by, its market share in the telecom business rose to 60% versus Exide at 22%. So not just autos, but it's now picking up pace in other segments as well. And that's why I've picked this stock on the A-list.
Right. Very convincing reasons. And yes, note her caveat on the stock's cost as well. Agam, you're going to give us a stock which is more mid-cap and therefore perhaps more mouth-watering.
Yes, and this stock had actually become a pariah up till 3 sessions ago.
You have to tell us the stock first.
Yes, this is of course Kaveri seed company, and this stock had actually taken a pounding when it comes to the kind of hit that's taken from its life highs of around 1,075. It came down to the levels of 400 and has since gained as much as 20% in just the last 3 sessions. And I'll also tell you the reason why it's gained that 20% is, well, the people have finally realized that, that it had taken a little bit of too much of a pounding. So in terms of reasons, we are looking at growth, of course, when it comes to the CAGR over the last 3 years. For revenues, it's as much as 46%. CAGR for profits over the last 3 years is 63%. Let's consider its debt as well, about just 1.5 crores as against a net worth of around 753 crores. And this, of course, also involves the reserves and surplus ones are around 740 crores. Moving on to cash flows, it's been cash flow positive for the last 4 years when it comes to on an operational basis, and moreover, considering the cash balance of around 66 crores, even against the peers, we are looking at 10 times valuations for Kaveri Seed Company as against Advanta, which goes at 42 times, and PI Industries, which part of its business is seeds, which goes at around 38 times. And finally, of course, there are some near-term concerns for this counter when it comes to royalties with respect to states, regulatory price cuts, but once again, analysts are of the opinion that these are near-term concerns, and in the long term, there is a significant upside to the Kaveri Seed Company, which is also the reason why I've chosen the stock today.
All right. Thanks very much for pointing that out. And of course, please note the caveats mentioned. These are analysts' opinion. What we are bringing to the table is only the list of facts, which is the compounded annual growth of the company, its cash flow, its debt status. The opinion is entirely analysts. We are not here to venture opinions at all. And now, Rima, to you for one stock from the Nifty pack. We tried to keep it a non-Nifty pack because the Nifty has some very obvious buys, but you couldn't avoid this one, Infosys.
Yes, Lata, generally the IT sector meets all the criteria of A-list. They all are cash rich, no debt, the promoter integrity is very good. The growth rates are fairly stable at 10 to 15%, though they've come off a bit from the earlier dot-com days. And right now, in the current scenario, the rupee depreciation is positive for IT companies, especially for their margins. Though on the flip side, a concern that I'd like to raise is that at a time when there is a global growth scare, the fear is the demand for IT companies could come down. But again, the caveat there is that most of the IT companies generate their revenues from developed markets and not so much from emerging markets. But the one in the IT pack that I've picked is Infosys, because this is a company which has been, gotten pounded. It's not done well in the last many years, but in Q1 of FY16, in the quarter gone by, it's shown you so much promise. So for one, the stock has already done very well. Very recently, it hit its 52-week high of 1,186. So from there, it's lost close to about 150%. On to, the revenue performance and profits, well, it's not as good as what it is compared to peers. So for instance, the revenue growth of Infosys in the last 3 years has only averaged about 7.5%, and this is half of what TCS has done. But because of its lower financial performance, it's also trading at lower valuations. It's trading at now about a 10 to 15% discount to something like a TCS. But considering that you're getting it at cheaper valuations and its Q1 performance, and the management commentary bodes well for the entire year, not just for FY16, but the management has given you a vision for 5 years. So the company's not done well in the past, so valuations are still relatively cheaper compared to peers. And Q1 has given you a hint that the company can do well, and they've got a roadmap or a blueprint for the next 5 years, so which is why Infosys has made it to my A-list.
All right, that's of course very, very convincing, Reema, Mangalam, Agam and Sonia. Thank you very much for inaugurating the A-list. In the days to come, our research team will put their heads together and sieve through more of the listed companies to get you companies which are fundamentally on a sound basis. Please note the caveat that's running. The stocks mentioned in A-list are not buy recommendations. They are merely to point out stocks that have done well on their fundamentals. We'll take a break on that note and then get back to